but again, so this is the slope of, the blue line means you're getting the wealthy are getting wealthier, right? Notice how the slope increased when you took the rate down to 1%, right?
Well,
Okay. Then you got the financial crisis. Okay, the rich people lost some money there, right? They're all fine, so they went back down again. But then we took interest rates down to 0% after the GFC, right? And the slope got steeper still because everyone could go borrow at 0% and invest in their assets, and their assets appreciated in value, right? Then we had COVID, where they handed out, almost $1 trillion worth of total $5 trillion, but huge subsidies through the PPP program and ZERP and QE, all that stuff, and it got even steeper still. So I mean, you're going to get to the point where the top 1% own everything, and everybody else owns nothing. So I'll leave it at that. But it's just it's a very graphic view of what you were talking about. The middle class is disappearing. Back to your other question, restate it again on inflation. That the people who get the money first benefit at the expense of everybody else. So it takes a long time for that wage earner to get a higher minimum wage. Whereas, the minute they take the interest rate down to zero, the smart guys on Wall Street go borrow money for 0%, put it in something that yields 20%. I mean, if you and I could do that, we'd be rich. We'd be billionaires, So, and that's the core unfairness of the system. And I mean, this, you're serving me up. You're serving me up a platform, and I hope you don't mind, to pitch my book on.
That guy for avid reader. I think it's important.
This is exactly what my book talks about. And the whole point, I think, as we talked pre-show, the whole point of the book is I want everybody, with people with zero financial knowledge, I want them to understand how they're being screwed and why the system is rigged against them. And I want them further to understand what we need to do to fix it. And we can fix it. Returning to sound money will fix it. Things. I mean, the one is, let's just collapse the whole damn thing and get it over with, rip the Band-Aid off, return to sound money, and the world will be a better place. However, if we go in that route, there are going to be a lot of people hurt who don't, get on board along the way and adjust, give them time to adjust. The alternative is we go slower and more people get time to adjust, and less people get hurt because a lot of people have taken the steps necessary to protect themselves. And so there's an argument for that as well. I mean, I think, you're younger, so you could probably live with either event. I'm older. I prefer it to go faster because I want to be here to see it.
Yeah.
But I, look, to me, it's going to unfold over the next 10 years. There's going to be a lot of change in monetary affairs. Things are happening really quickly now. I mean, things that I just never could imagine happen. I mean, the approval of the ETF was a huge deal. Larry Fink at BlackRock, the biggest asset manager in the world, embracing it. It's a huge deal. What Michael Saylor is doing with MicroStrategy, basically, hoovering up the entire bond market, that's a huge deal. I mean, it's, sovereigns probably buying it. We know El Salvador, but we know, gosh, I got to make a decision. Do I want to ignore this and become irrelevant as this thing becomes more important, or do I want to figure out a way to try and make money off this thing, which seems inevitable? And obviously he chose to make money off it. I mean, I think he's got the biggest ETF, if not close to it. Fidelity's up there as well, and they're getting 30 basis points, and he's doing extremely well. I mean, interestingly, and I'm drawing a blank now on the name, but there was another fund manager, maybe it was Vanguard. I think it was the CEO of Vanguard, shat all over it, said they're not going to do it. Well, he lost his job. I mean, because it's you can't deny that it's working. I mean, if you look at the investment performance of this asset class for the last 15 years, there's never been anything like it. And now what's the negative? The negative, as we discussed, there's big volatility, and people who aren't in it and are thinking about getting into it really need. I mean, those cycles are part of the process. And the way that senior people or older people who are getting into this, the way you deal with that is you don't put 100% of your money in this thing, but you put in 10% or 15% or 20%, a number where even if you only have 10%. Look, I think this thing is going to go up 10x, and I think it's going to go up 10x again. That's probably over 20 years. Yep. That's 100x your money today. So if you put 10% of your net worth into this thing today, and it went up 10x, well, you would double your net worth. And if it went up another 10x, you would 20x. That would be great, right? I mean, you're like 2,000x your net worth. So the point is that you've got to have a long-term perspective on it. And I always say the wrong allocation is zero. Even only 1 or 2% of your net worth in it, it's going to make a difference. And if you know about it, you don't put 1 or 2% in. What are you thinking? I mean, you could. There's not a soul in the world that can't afford to lose 1 or 2 that has savings and can't afford to lose 1 or 2% of their. We're in a sovereign debt crisis based on the debt doom loop that I described before. So that's kind of your starting point.
What's that mean, a sovereign debt crisis?
It means that the large industrial economies in the world have taken on more debt than they can service, and as a result of that, they either have to let the debt collapse, and this is best described in a book by Ray Dalio, or they have to inflate in order to service the debt. And, because letting the debt collapse creates an outcome that looks like 1929, they're much more likely to run the printing press and inflate to try to get their way out from underneath it. So if we're in a sovereign debt crisis, which I believe we are, and we haven't really seen one of these since World War One. If we're in a sovereign debt crisis and we believe the government's going to print, which I do, then you want to own things the government can't print. So, land is going to go up in value in nominal terms, and, stocks are going to go up in value. Stocks, if you believe they're good stocks, there'll always be certain stocks that do well, even in a bear market. But, in general, the stock market will take all stocks down with it if liquidity becomes tighter. It's an interesting. The stock market's tricky. If you study, and I don't know if we're going to a hyperinflation, but we're certainly going to have we're certainly going to have inflation, in my opinion, and potentially very high inflation. If it becomes hyperinflation, the stock market's going to do very well in nominal terms. That is, if you look at pictures of the Venezuelan stock market, or the Zimbabwe stock market, or the Weimar German stock market, they all went up a lot. Problem is, so did the price of everything because the currency was failing. So, stocks do represent a claim on a business, but to me, it's not nearly as clean as. One of the things I like about gold, one of the things I like about Bitcoin is you don't have management teams to screw it up. They're both full of the number of users that are added, so it's exponential. It's very unlikely that somebody's going to come along and change it. It'd be like saying, well, somebody's going to make a better Google. Well, everybody goes to Google, and everybody who sells is on Google, or wants to, information pays for placement on Google, or somebody's going to make a better Amazon. It's possible, but it's not likely. So all these other coins, to me, they have flawed monetary policies. The fact that you actually have to expend energy to mine Bitcoin is extremely important, because that's what central banks don't do. They just push a mouse button. It's mouse click money. Money by its very nature has to be scarce. And so you have to either work hard to earn it, or if you're producing money, you gotta, quote unquote, mine it. And it's actually interesting that the term is used in both industries. In the old days, we've got 212,000 tons of gold today. It'd be a couple of Olympic swimming pools full of gold. And, in 45 years, 50 years, we'll have twice as much. There'll be more. And so that's dilution. That's monetary. The soundest form of money before Bitcoin is monetary dilution. The thing that makes Bitcoin so weird and interesting and potentially has such huge upside, and so it's just kind of it's a complete paradigm shift, is that there's never going to be more than 21 million of these things. It's just like, whoa, hang on a second. You mean to tell me you can have a kind of money that does not dilute? Right now there is dilution. We're adding 0.8%, 0.8% per year to the supply. But as you know, every 4 years, that number goes down. And in 2140, the last Bitcoin will be mined. And effectively in another 10 years, we'll be down to the point where, we're at 99% has been mined. And so, the remaining dilution will be negligible. So that's really, really